Hi everybody, it's Dave. It's Friday, March 20th, 2009. I'm glad to welcome back to the fold Greg Newton of NakedShorts.typepad.com, who has made the long, arduous trek from Connecticut down to Florida. Greg, welcome back.
Thanks, Dave. Hi, everybody.
Well, it was a great show that's been put on both in the Congress, of course, and by the Fed and Bernanke, and by gold markets and crude oil and commodity markets in general and bond markets. And financials were leading the charge higher on short squeezes and made about a 60% move from the low to the high in the space of 10 trading days or so. We got overbought. I posted the McClellan oscillator these last few days. I post it quite frequently anyway. But when it gets near 100 like that, you just know we're going to have some profit-taking, and it's been very accurate in that regard. So, Greg, any thoughts?
No, at the risk of being repetitive, just another week of gratuitous market violence. Everybody was buying the rumor into the Fed meeting, and they weren't too sure what the rumor is, but they were buying it, and then they sold it with a vengeance the last 2 days.
Yeah.
But the market off that low in the first week of March, there's been a very good, very nice, very solid move up, and if nothing else, it was going to take a breath, and that's what it's done.
Like I said, I put the McClellan up there, and that's been pretty reliable. I also drew what I think is the resistance line on the S&P, on the spiders anyway, at around where we got. And we just backed right off that, which isn't a coincidence to me anyway. That's why I draw those little lines like that. So it did back right off that, and whether it can charge through it is really going to depend on news. I read today a lot of people talking about, well, we've seen the worst of it. The fourth quarter of 2008 and the first quarter of 2009, it will mark the bottom and so forth in terms of economic news and earnings and all that other kind of stuff, which is the same kind of story we heard in 2008. And I think we heard some of that in 2007 as well. Is that right?
Absolutely. Yeah, no, it's a bit like Fred Smith at FedEx was out this week saying it stopped, the rate of decline had slowed. He didn't say it was getting better. He said that it had stopped getting worse at the same rate it was earlier.
Yeah, we have one plane flying now. We can't get any lower.
The bottom is in, values are compelling, and away you go. Yeah. But I think that was the subplot to what the shock and awe that came out of the Fed with the announcement that they're going to be spending $300 billion on treasuries.
All right, well, let's talk about that announcement.
Well, number one, I think the important thing about it is that what the Fed said very clearly is that they think it's going to get worse before it gets better. In fact, some of the language in their traditional statement that had referred to the prospect, to improving prospects in the future, was actually removed. This $300 billion worth of money that the Treasury is going to print and the Fed's going to buy amounts to about 1/10 of the estimated new debt issuance this year by the US. It's something larger than a drop in the bucket. It puts a nice bid under treasuries to help keep interest rates low, which seems to be the game at the moment. In as much as it's transpired that the AIG bailout was much more a bailout of Goldman Sachs and its counterparties, which I think we knew from the beginning, but never mind.
They also added $750 billion in mortgage backs, which helps Mr. Gross, of course.
Right.
Now, how effective do you think that will be?
It's all effective. I mean, it's massive amounts of money being poured into what is at the moment a rat hole. At the point at which, if they get enough money in there, it may stop being a rat hole. So far as the mortgage market is concerned, the new place that I'm renting down here has been vacant for 3 years, since just after it was completed. Before I moved, I looked at an apartment not too far away that was finished 2 years ago, has never been lived in, and where they just cut the rent from $3,800 a month to $2,000 a month. I mean, it's a beautiful apartment. There's a roof with a built-in Viking grill and the whole 9 yards, and they can't get anything like even the maintenance costs on that place for the properties. You know, that is the state of the real estate market, certainly around the neck of the woods. That's the concern in a lot of places. Leon Black was out yesterday saying it's going to get worse before it gets better. So money into rat holes helps, but depending on how many rats it drowns, you know, it's still a rat hole.
All right, now let's go back to AIG and the idea of the Chinese being bailed out on this particular go-around with the Fed. Let's start with the Chinese first and your thoughts there, because I thought that was interesting.
I just see, just getting back to what I said about the AIG bailout, that it was really a bailout of AIG's counterparties. The Fed action this week in buying the treasuries is, in some extent, a Chinese bailout, because obviously they want to keep the Chinese buying US securities, and the only way to do that is to keep a bid in the market, especially with the issuance we've got coming up. The problem is because it's certainly short term, it's led to some desecration of the dollar, is that the Chinese, whatever they made on the up move in the bonds, they lost on the down move in the currency conversions. It's an intriguing game in which we're involved at the moment.
What do you think about the prospects for inflation and what happened with gold and so forth?
The inflation is going to be a problem. It's not an immediate problem and probably won't be for a while. You know, a global economy that may not be on its knees, but is certainly not particularly healthy. There is no demand pressure to spike the prices of commodities the way they spiked a couple of years ago now, or last year in fact. So it'll be a problem. The challenge for the Fed at this point is going to be taking away the punch bowl, and not taking away the punch bowl so quickly that it interrupts whatever recovery starts to happen at whatever point, but also making sure it does take it away before the consequences of this Weimar Republic type money printing start to be suffered.
Well, we'll probably be adding to our commodity positions just on base of technical situations, not whether or not I think there's going to be inflation or not, although it seems likely at some point. Nobody's precise in knowing exactly when to take the punchbowl away. Greenspan certainly wasn't. I don't know that Bernanke has done that great of a job in terms of getting into this mess as quickly as he may have should have, but that seems to have been one of the problems. All right, folks, stay tuned, and we'll talk to you in another week. Thanks, Greg.
Thanks, Dave. Thanks, everybody.